I have a couple of what I think are the near misses that make life interesting, if painful sometimes. And, a quick story I'll share on that to open up is when I was 24 and I had started Skyline, my first investor was Jigger Shaw's business partner, Bernie Zarin, who I love dearly, set up a fund called Clean Feed Investors to help myself and some other early entrepreneurs. And Bernie would always tell me that until the money hits, doesn't even matter if the docs are signed, until the money hits, you don't have it. And
Exactly.
his big story was that actually happened to him. It was 1991, and he had a $30 million financing for a landfill natural gas business he was running, and the money didn't show up. The docs were signed, and he called the bank, and he called the bank. He called all day, and nobody picked up. And finally, somebody picked up, and they said, bank's gone. And he turned on the news, and his investor was the Bank of Kuwait. And it was the day Saddam Hussein bombed it. And it's the most clear example of the deal was done, but the bank literally physically was blown up and didn't exist. Stuff happens. And, he told me that story when I was 24 or 25, and I've never stopped thinking about that. And I've had a couple of experiences in my life where you're really, really close. Until that money is wired, you don't have it. And
exactly. Yeah. I think that's a perfect opening. And I mean, a lot of people know you, Zach, obviously at K Street and beyond, but you've been a part of, I guess you've been a syndicate member for a long time. You've been on the executive committee of K Street. You've been an LP in our fund. We've also invested in several companies when you were there as one of the early employees. So there's so many stories. And I think you've got at least three really interesting exit stories of companies that you were actually part of. And many other, I'm sure, from an investment perspective and otherwise. But before we get into that, maybe just a quick intro from you for those who don't know you, and then we can dig in.
Awesome. Yeah. Thank you. Yeah, I'm a startup degenerate. So I'm involved in, I think I've invested in or currently invested in 60 plus companies and ranging the gamut, a lot in clean energy, but a lot through K Street and other avenues where, this type of investing is a way for me to learn about businesses and industries I know nothing about. So I'm highly illiquid, but tied into a lot of companies that I find really interesting and, and hopefully positive for the world. Been an entrepreneur for almost 20 years. I've started a couple companies, started and run one for many years with Skyline Innovations, which turned into Nextility. Ultimately did not have a successful outcome in that business, which was a hard learning experience. We busted our butts for almost a decade. Then I went to Arcadia. It was kind of a magical 4-year experience helping Kieran build that up. I joined because
that's how I met you, I think, originally.
Yep. Arcadia days, and started an angel group. I think Kieran introduced us, and we ended up folding our fledgling little group into. But then I left Arcadia as it grew to join smartac.com, which is a company that K Street invested in down here in Houston, where I am now. And then as a COVID hobby project, I set up a business with a couple other friends around solar investments, Redball, which has turned into my full-time job. I'm now the CEO of our operating business, which is to own and operate distributed small solar assets. And then at the parent company level, we also kind of have our own private investment platform where we invest in early stage energy development companies, kind of anywhere from $100,000 to $1 million. And it's just the private capital of the four of us who are principals. So anything and everything energy, but also every type of investment under the sun where I can learn about an industry I know nothing about and feel some additionality to the dollars I've tried to make when I've had the available capital.
Yeah, you've done so many different things, even just in the time I've known you. It's kind of crazy. But there's 3 exit stories maybe worth discussion. But yeah, maybe let's start there and just a quick backstory on the 3 of them, and then we'll go from there.
The first exit I ever had was a really important one to me in my life because it coincided with my own company going down and losing all of my money, losing my investors' money. That's a painful experience as an entrepreneur. Everybody knows what they're getting into, but it hurts just the same. But I'd lost everything that I had, not just on paper, but I borrowed $200,000 that I owed and from family, from friends to start the business back in 2009. It was 2015, 2016 when I stepped down as CEO. But along the way, a lot of, as I'd been building Skyline, people had asked me to join their boards of advisors, boards of directors, that help people start to raise some money. And one of my investors and advisors and board members had brought me into his company. So I was actually the only non-founder shareholder of that business. And, the punchline is that his company sold, and my little stake in that business and that sale paid for my wedding, and it paid for all of my non-family debt. So it was monumental
Wow.
to me that I got out of debt to everybody except my grandparents and my parents. And that was important. I paid everybody off with interest and it paid for my wedding. But it was also, I think, for my wife, Martha, and for me, it's a reminder in startup life that the cash does go both ways sometimes. It's not just you putting in. Sometimes you get a win. And if you haven't had a win or you haven't had one in a while, or if you lose, you can forget that. So it was a big deal. But it was also a very interesting deal, I think, in that I learned the power of a founder being in financial position or a business being in financial position to not have to sell. This company was called One Energy Systems. It was a battery optimization play, kind of very early into that world. But there was this incredible phase in kind of 2015, 2016 when big conglomerates were snapping up all these little battery software businesses. From my perspective, the industry didn't know what was going on yet. Nobody really knew what was going on, but it was like, I'm a multi-billion-dollar conglomerate. I have to be in on this. And I think Dave, the founder, saw that. But I think what's also interesting about him and shaped my perspective on startup funding was the founder was independently wealthy from being an early Microsoft executive. And he initially turned down multiple bidders who offered more for the company, honestly, than I thought it was worth. Certainly, I was excited to get my payout at the first offer, and he turned them down. I don't know if it was a bluff or not. I've always thought it was kind
Right.
of a bluff. But he knew the market was frothy. He was losing money, not a lot of revenue, but he was in very candid position to tell suitors, I'll self-fund this forever. And he could. And when you can say that, and when somebody knows that it's not, that you're capable of self-funding forever, to be honest, I was a little bit devastated when he turned down the initial offer because I was like, oh God, I could really use that money. 3 months later, the same bidder came back to him and offered him double, and he took it.
Wow.
And we got it. If he hadn't had the resources to be able to say, I'll just do this forever, I don't need you, they would not have done that. But they were desperate. The buyer was desperate to be in that market. And he knew that. And again, would he have self-funded it forever? I don't think he would have. But he was in position.
But always better to be, to be in a position of power in that situation.
Yeah.
So it worked out.
And it was interesting. Dave and I met because he had sold his previous company to GridPoint, where I was a product manager in my early 20s. And, he sold for stock and it didn't work out. He owned a small minority position in GridPoint, and that didn't work out for him. And so he had said to me for years, I will never sell this company for anything but cash. And again, most of us founders, you can't say that because sometimes you might need to sell or you're not making money. It's not your choice. But he was in position to say things like that and back it up because of his independent wealth. And it really benefited him. I mean, we got a lot more for that company than I think anybody would have thought it was worth. And kudos to him. And it changed my life in the sense that I was mostly debt free and could get married. It was huge for me.
Yeah, incredible.
And I was one of, he owned almost the entirety of the company. And I think I and 2 or 3 other people had tiny stakes, but I'm very grateful for how that played out.
Yeah. And that was 2016, you said, right?
2016. Yeah.
Yeah. So frothy market for that specific type of company at that time, I guess. And it's just a good time to be selling.
He hit a very narrow window for that type of business. And again, kudos to him. He saw it.
Timing, it's everything. They always say in venture, you only do 2 things, right? When you got in and when you got out. But maybe talk a little bit about Arcadia also and Relay.
Yeah.
Was Relay before Arcadia? No, I can't remember.
Yeah, Relay was actually first. I got in with my main investing partner, Nick. We made a small investment in a type of company that's usually outside of my wheelhouse, which was it was a trucking payments company that's just done terrifically well. They built a really nice payment flow system for a quote unquote niche industry, but to solve an issue around payments to the people who load and unload trucks so that the truckers can sleep. Those folks are usually independent. It's all been done in cash. It's all historically in cash. You pull up your truck, you've been driving for 12 hours, somebody's unloading the contents. That person may or may not belong to a firm. How do you deal with all that payment flow? They came up with a really clean way to do it and have it tie into accounting systems. And we invested in 2019 at a single-digit $1 million valuation. And in 2020, when the world changed from an investment perspective and everything got really frothy, we got an opportunity to cash out as much as we wanted at a low 9-figure valuation. So, well over 10x our initial investment. And I think one of the lessons learned that I had, and this factors into Arcadia for me as well, with Skyline, I mean, I had several up rounds before a down round. They don't only go up, they don't only go down, of course, but I think I had kind of beaten out of me any expectation that just because you've been seeing something do well, it will continue to. And I have a ton of respect for the Relay folks. It's continued to do well. But I think, again, similar with my experience with Arcadia, it's like just take some chips off the table, especially when private investing is the dominant, in my life, and my family's like kind of near 100% investment format. You just take chips off the table and be grateful. And so my investment partner and I looked at each other and we ended up taking half off. Interestingly, I mean, there has not been a secondary opportunity since, but it was tough. I think in the moment, it's tough to make the call because you're like, oh my God, it's up 15x in a year. What if we just hang on for another year? You start to do that math. You're like, well, my little investment, I could retire off this one thing when it's 1,000x. That's not how this works. It certainly may or may not be how this works. It's not usually how it works. So we decided to sell half and be extraordinarily grateful. And we kept half. And on paper, it's up many more X. But 2024 is not 2020 and it's not liquid. And I give all the credit in the world to that management team and the company. They've done, again, really well. But I'm really grateful that we took half off the table when we could. It'll be the best IRR deal that I ever do in my life because of how much we took off when we did. We're letting ride. So, I think a remainder of our stake is up like 70x or something. But again, who knows when we'll ever see that. And by selling half, it's okay if it's a long time or if we don't.
Makes a ton of sense. And you were only an investor of that company, right? That wasn't one where you were part of the management team at all.
No involvement at all. And just dumb luck to be along for the ride.
Yeah. Well, I think it's important for people to realize that you don't get opportunities to exit all the time, even though sometimes it seems like they're all around you forever and they've been happening for a long time. It doesn't mean they're going to stay that way. Yeah. And it's sort of like important to keep your head in those situations. I know like ID.me is one of our big unicorns. Of course, you know that. And same situation happened. It was, it was already unicorn status. It was growing insane. People had an opportunity to take chips off the table and not everybody did. And I think obviously the company is still doing well and those shares continue to grow in value, but there hasn't been a liquidity event since then. And I think the expectation at the time was that maybe they were going to go public very shortly thereafter. And you just don't know. You really don't know. So it's a sort of a risk equation that you have to make. And then Arcadia is the third one.
Yeah. I was obviously very fortunate to be early at Arcadia. I was an advisor before I joined, and Kieran and I had become friends, just kind of a once in career type of thing to get to be a part of. The growth that we had in 2018 and 2019 was obviously a lot of fun and very unique. And again, coming back to they don't only go up part, I made a decision to, at every opportunity, to sell kind of 15% of my stake in a very dispassionate way. Now, there's only been 2 opportunities, and I've taken advantage of both of those. And I have a lot of faith in him. I have a lot of faith in the business. I love the company. Again, tying to my own experience with my company of, many years of feeling like we're doing pretty well, and then it all falls apart, was just I'm not going to factor in the fact that he and I talk, every week or two, and here's how I'm feeling about the company or my old team that still works there. How are they feeling? I just didn't want any of that to factor into my decision. It was like, just be grateful each time you can take 15% off. Don't change the percentage. Don't do anything, just kind of fixed. And I've done that, and we were able at the end of 2021 to take a few chips off the table. And I used that to fund my portion of my current business. Exactly. But I think my big lesson from that, and again, it ties to my own experience with my prior startup, was just be grateful, take a few chips every time. It's not a reflection of if you think the company is doing well. It ties to nothing other than kind of personal financial stability and the understanding that you need some liquidity along the way from these types of investments financially, but also psychologically. If you go too long with no exits, it starts to change and you start making, I think, worse investing decisions. And I think it's been really psychologically helpful for me to have a few times along the way to get some chips back.
Yep, definitely. And maybe now you can share a little bit about, I don't know, what went better than you expected, especially maybe with that first exit with One Energy.
Yeah, what I've seen is so much of this especially when it gets down to the very nitty gritty and you're in an exclusive period with the investors. So much of this is tied to who's holding the cards, and certainly some of it's tied to kind of general market timing. But again, I come back to my experience with One Energy. The CEO was able to say, you don't hold any cards over me. I'll fund this forever. I don't need you. I don't need your money. I get somebody else's money or I'll sell to somebody else, but I don't need it. And it totally changed the power dynamic to the positive. And I've had, as you and I were kind of discussing before we jumped on the podcast, is, I have multiple experiences in my life where really close friends of mine, CEOs of companies that I love, CEOs of companies where I have a 6-figure stake, were literally on the day of wiring money and the deal fell through. And this is in the kind of post 2020, 2021 world. So all in the last couple of years. But those companies, when it got down to those final negotiation points, when everybody kind of thought you were done, ultimately the investors held cards over them. These were companies that weren't cash positive, and the investors knew that they could try and wring the last term or two out. And I've seen multiple deals fall apart over that, where again, the companies didn't hold the cards. And I think that's just been a big learning lesson or a little lesson for me over the last decade, is just how hard it is, especially as startups. Most of these companies are unprofitable. That's why they take venture. It's a certain business model, but that power dynamic goes back and forth. And in 2020 and 2021, the dynamic was in favor of the entrepreneur, and you're selling for 30 times revenue. And, it was wonderful in some sense. The dynamic has shifted back, and it's easier said than done to say, well, you just need to have more control of your business and the dynamic in terms of not needing other people's money. It's super easy to just say, oh, just don't need other people's money. But the people that I've seen who didn't have done extraordinarily well in comparison. And I spend a lot of time thinking about how we position our current company to be in that spot where you don't have to have other people's money, which again is hard to do, but it seems to mean everything, frankly.
It does. I couldn't agree with you more. Just a position of negotiating power in those. And even Arcadia, I feel like Kieran always does a phenomenal job of that in every situation, in every raise. And it's a very admirable skill that I don't know that you can teach it easily, but I think it's an important thing to learn.
I called him asking for advice last week. I mean, seriously, I think he's a tremendous fundraiser, but something I really admired that he has done is he is always out raising when he doesn't need it. Again, easier said than done, but he's, one raise ends and then he's back at it. He has made sure that in an industry that there's a lot of people that have struggled for cash. Cash is king, and just massive kudos to him. And I've learned a lot from him on that. So absolutely, I call him when I need fundraising advice.
Yeah.
But he's been so smart about that. And I don't think you can teach it. I don't have that. I've raised a lot of money. I do not have that skill or anywhere close to it in the same way, or the thoughtfulness around capital timing and structure and making sure you've got 4 people at the table at all times. And it's taken me a long time to try and learn what I think is much more intuitive to him and some others out there.
I totally agree. I almost feel like I should do an episode just on that topic because I think it's so important and it's not taught anywhere. I think, I don't know. We'll have to ask Kieran.
Totally. But you're not taught. I mean, my very first with Skyline, like I didn't know what a convertible note was. I didn't know what a safe note was. And, I enjoy investing in founders who are learning that for the first time, because, you see your own early flaws in that. And,
and you can sort of help them.
And you can help them, but where would you learn that other than just by starting it out and
doing it? That's the thing. I don't know. Part of why we wanted to do this season on exits is because most people have never been through an exit, or if they have, they've only been through their own, or maybe 1 or 2, maybe 3 in your case, which is very rare. But hearing all these different stories, there's like something different about each of them that I think sort of can help people, early founders and early investors, really, when they're thinking about how these things come to an end eventually.
The type of exit that I've never been through that I'm interested in, of course, is the founder. I've not been through that as a founder and as a co-founder or principal of Redball. We'll see if that ever happens for us, if that's the path we go, or if we're lucky enough to have that happen. But the experiences around that, about transferring control of the thing you created to somebody else, how that feels. I've certainly been interested in, looking forward to that, and I've never had that. I've had a couple exits as we've discussed around companies that I've been highly involved in and an advisor to, or a board member to, or an early employee. that would be a new experience that I'd love to learn from, and what that feels
It's
like.
funny. It's funny to hear you say that because I know that I guess I know that technically you weren't a founder in some of these companies, but the ones you were an early employee of, I always think of you as a founder. Like you always think about it like a founder. So I don't know that
Well,
you'll.
I'm curious what you, as somebody, because you started companies too, I think you try to think of how to be an early employee, and you have your founder hat on of what you want to see. But having been a founder, you're so conscious when you're not the founder. You're like, this is not my
It's
thing.
true.
This is your dream that I've co-signed on, and I've bought into your dream, but I'm living out your dream and vision because I believe in it. And that's how I felt with Smart AC, jumping on Josh's bandwagon, or with Arcadia, and jumping on Kieran's. And I feel very lucky to have gotten to do that. But it is a different feeling when people, have jumped onto your dream. And I had that with Skyline, and I'm a part of that with Redball, though certainly Redball, this was my partner's business as much or more than mine from the start. So
Yeah, it's a
that's a
good point.
different feeling.
It's different, I think, too. Founders, like having been a founder that went through an exit myself, like you always think it's going to sell differently or for a different purpose, right? Like you think something's valuable about it. That's not necessarily the reason why it
Yeah.
gets sold in the end. And I always find that's a question I always like to ask if someone's on here, that they were the original founder, because I find more often than not, it's like you thought it was the technology, but it was really the people, or you thought it was, your revenue, but it wasn't. It was, it was.
What was yours? I mean, I remember your company sold almost, is it 10 years ago now?
Yeah,
8
gosh,
years
a long
ago?
time ago. Yeah, mine sold because of data, which was not at all what I thought. I thought it was the technology, the IP, the team, the growth. It wasn't any of those things. It was the data that we were collecting that was valuable, and
Yeah.
that's why we ended up selling earlier. Or also, we sold a lot earlier than I expected. I only ran that company for 4 years, and it could have been, I felt like we could have could have been a bigger company, could have run it for longer, could have been a bigger outcome, but again, to your point, it was an all cash exit, so no equity and no escrow, nothing, so it's like you just have to take those wins when you get them.
Yeah. Awesome. Yes. It's amazing that you knew that early enough on. It took me a long time to understand that, but you knew that earlier in your cycle of entrepreneurship than I did.
I don't know. It's a longer story than I can tell on this podcast, but it did work out in the end. So that's a positive thing. Well, cool. Any other like final thoughts or takeaways that you would share? I mean, I think these were already some pretty good ones with all three of those stories, but anything else you'd share with investors or early founders, first time founders?
I don't think so. I mean, I've beaten a dead horse on taking wins along the way, whether as a founder or an early employee, for your own financial health. I've been really excited and pushed a lot of friends of mine. I think something that, if you've got a startup that's lucky enough to have a competitive round, I've nudged or kicked in the back of the leg multiple of my friends to negotiate in secondaries that changed the dynamics of their family, the financial position of their family, and who've been fortunate to do that. You need a competitive round to do it, but a lot of VCs have been willing to let the founders take 10% off. I used to always bug Kieran about doing that for himself, but a lot of friends lately who've been fortunate to, and that's not something I was ever in position to do, but just seeing how big an impact that's had on people's lives and their families' comfort with them continuing on running a company that they've been running lean for 6 years, and saying, it's easier for me as your partner to co-sign on for 5 more years of this because you took something off the table.
Right.
I've been excited to see people who were in position to fight for and get that lately. I don't think there was a mentality around that 10, 15 years ago. And now it's longer. It seems like, it's a non-offensive part of the conversation that investors should be having with the founders. And I'm seeing more of it. And I'm really happy for the people who've been able to earn that. Right.
Yeah, it's a good point, because I think historically, like it was considered sort of a red flag if a founder was doing that, and now I think that's kind of gone away because companies are staying private for so much longer, and you have so much more risk on the table at that point that it just makes sense, So
well, and once if your investors don't have to take it, but once you've been able to get secondary opportunities for them, whether they take it or not, you have created that. I mean, I think there'd be a little more stigma if the founder gets to take money off the table and nobody else does. But if that opportunity is available to others and you've created value and people are able to make a choice, but in some sense, you've won for your investors, then you've given them an opportunity to take a win. I think the stigma around this is gone. And I think that's a great improvement ecosystem over the course of my career in it. Yeah.
Totally agree. Well, thank you so much, Zach, for being here. And that's a
Thank
wrap.
you. Awesome. That was fun. Thanks so much, Paige. Appreciate
Cool.
it.